Hey everybody, you're watching Bull Boom Bear Bust. Top story here, major bank warns recession. GDP actually dropped for the first quarter. No surprise. We need more stimulus checks if you want GDP to increase, or more loans, but that means people that are already in record levels of debt will have to go even deeper in debt, which is happening, but just not fast enough. We're going to talk about the GDP and unravel that whole scam for you. Automobile loan delinquencies continue to rise. And also an expert, and I'm doing quotations right now, expert predicts more economic shocks. Well, I think that person's right, but are they really an expert? Let's go ahead and get started right here. GDP, that's gross domestic product, fell at 1.4% to start the year. This is the first quarter 2022. Now we're just exiting the first month of the second quarter. So obviously we're not going to see the second quarter numbers until around July. So when I say halfway to recession, officially 2 consecutive quarters of negative GDP growth equals a recession. But here's the trick. They can just paper over a recession by sending out more stimulus checks. We actually did not enter an official recession in 2020, even with all the economic destruction, all the job losses, all of the rescue programs that had to be given out for rents, foreclosure moratoriums, of course, stimulus checks, freezing of late fees, freezing of payments. They still haven't restarted many of these programs. Actually, the eviction moratoriums are still in place in a lot of cities. The student loan debt forgiveness, or not the forgiveness, but the delay or the pause in repaying these loans still has not restarted. So we still have not exited the rescue from over 2 years ago. So how ridiculous is it now that they're telling us that there's a recovery? And now even more proof that there's really not a recovery. GDP fell. Well, here's the thing. GDP can be pushed back up again artificially. All you have to do is do a broader cancellation of rents, freeze foreclosures again, freeze late fees and loans, keep the student loan pause in place, send out more stimulus checks. Why? Because the American economy is based on consumer spending. It's absolutely ridiculous that that's the way it's measured. But honestly, if they would send out a whole bunch of checks, GDP would then again rise. But here's the problem. When you send out a whole bunch of checks and money to people that are not working or not producing anything, inflation gets even worse. So they're afraid to do that. So it's either bigger inflation or declining GDP. So they're kind of trapped right here if you think about it. Okay, so on one hand, the quote unquote leaders, they don't want GDP to fall because they know that's an official declaration of recession. If it happens 2 quarters in a row, we're halfway there. But on the other hand, if they send out too much stimulus and nobody's producing anything still, prices will explode even higher. Can you imagine prices rising even faster than they are now? It's going to be an absolute disaster if they try to come in and artificially pump up the GDP like they did in 2020. Take a look at what's happening with consumers right now. We know the savings rate has dropped to more than a 5-year low, but yet the story out there is there's a recovery. There's a recovery. Well, now they're going to have to come up with new ways to explain what's happening. And the consumers are feeling the pinch. Recent article right here, consumer disposable income confidence falls to record low as rising cost of living takes hold. Folks, a record low. Consumer confidence already took a plunge. We talked about that a few reports ago. Disposable income now with the declining savings rates, it's leading to an all-time low. People are feeling the pinch. So more and more people are waking up and they're not believing these stories, these fables that are being put out there by a lot of the news outlets, that there's an economic recovery happening. An economic recovery for who? The CEOs? Of course, they're getting record pay raises. The record profits are going into the pockets of the people at the very top, the top 10%. Of course, they're going to give out some pay raises to keep people from fleeing and leaving the job. So let's talk about the expert that we're looking at right here on our screen. This expert, wait a minute, she's not an expert? What, she's been wrong about pretty much everything? Wow, okay. Well, I thought to be the Treasury Secretary, you had to be an expert. Well, remember she was out there telling us that inflation was transitory. We also had the head Fed boss out there telling us the same thing, Mr. Powell. But yet these people get to keep their jobs. Imagine being wrong over and over again and still being able to keep your job no matter what, no matter how wrong you are, no matter how much damage you cause by leading people into false expectations or giving false hope. But you still get to keep your job. So Yellen is out there warning of more shocks and challenges to the economy. Let's hear a big thank you, Captain Obvious. Now, she was out there yapping that a lot of this is caused because of the conflict over in Eastern Europe, and that caused, these prices to rise so fast. Well, if you look back, prices were rising for a long time, even before the war, even before the health crisis came out. Prices were already rising way beyond the budget. We've been in a housing bubble for many years now, and I mean that prices have been higher than what we saw during the 2008 peak. Prices have been higher for a couple years now, and we're more detached from incomes now for the prices of homes and everything else than we've ever been at any point in history. So it's obvious there's going to be more economic shocks. It's mostly going to be towards the middle class and the typical U.S. consumer. The people at the top, especially the top 10%, they're doing better than ever. They're buying more investment properties than ever. And this will continue. The wealth gap will continue to widen. Well, now that we're halfway to a recession, Deutsche Bank is out there warning a major recession is coming. Deutsche Bank is warning of a deeper downturn caused by the Fed's quest to knock down stubbornly high inflation. And to make its case, Deutsche Bank created an index that tracks the distance between inflation and unemployment over the past 60 years, and the Fed's stated goals of those metrics. That research, according to the bank, finds that the Fed today is, quote, much further behind the curve than it's been since the early 80s, a period when extremely high inflation caused the central bank to raise interest rates to record highs, crushing the economy. Remember, the Fed funds rate was about 18% back at that time in the 80s. Now, with the levels of debt that we're in right now, as consumers, as a nation, government debt, city, state, and local, it's impossible to raise rates to where they were back then at 18%. 18% would bring on an instant, not just recession, but a depression. Look, I'm no fan of Deutsche Bank. They're one of the worst offenders as far as the derivative exposure. Now, as the walls continue to close in, you're going to see more warnings like this coming out of banks. And again, it's going to be very difficult to try to stop inflation by raising rates, but not damp down GDP. So big problems ahead, folks. A 0.5 percentage point interest rate hike is on the table for May. So we see that they're still going to keep raising unless something jumps out of the woods that changes course immediately. And you may think it's not a big rate hike. It's really not a 0.5% in the grand scheme of things. But when you look at the levels of debt, it has a major impact on purchasing power. When the average home is $1 million, if you look at what's happening in Orange County, that's a big difference in how much a loan people can qualify for. Now, in this rising interest rate environment, so we have stories like this now out there urging people to take out personal loans now, to consolidate all their credit card debt into personal loans to get a fixed rate for a set number of years. So expect new ways to get people to continue carrying their debt. I still think inevitably it's going to be a bankruptcy surge unless some bigger rescue programs come out, but those are going to be also risking pushing up inflation even higher. Because when you pause people's loans and when you pause their payments, when you tell them they can't get evicted, that they can't get kicked out of their home, well, they all of a sudden have more disposable income, and that's more spending. and still not much being produced. In fact, production is dropping. Look at what's happening with the farms. Food prices will continue to go higher. We see what's happening with the fertilizer exports. Russia, one of the biggest exporters of fertilizer in the world, ceasing exports to the U.S. So this storm is getting darker. It's really just getting started. And again, they're in a very difficult spot between stopping inflation and handing out free money and helping people continue to spend money. Money that is running out for most households. And the reckoning day is coming. It may not hit all at once. We're probably going to see a slow deterioration just like we've seen up until now. But keep on stacking, folks, because that's a wild ride. And it's about ready to get a lot crazier. Thanks for being here. Appreciate you just listening, supporting this channel. Even the people that don't hit like, if you happen to like what we talk about, please do me a favor, hit that like button. It helps us get recognized in the algorithm. If you haven't subscribed, please consider subscribing, because we're going to keep an eye on all the major components of the economy and to help you get prepared for what's coming. Thanks everybody again for being here. Peace, big love. Bye.